Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by MarketFi. I'm your co-host, Joel Elconin, along with Brianna Valesky. And we have Reverend Emmanuel Lemelson on the line of Lemelson Capital Management. He's joined us here over the past 6 months, year, making some tremendous calls in the market. Reverend, how you doing today?
I'm good, Joel. Thank you. It's a pleasure to be with both of you again.
Okay, let's just start, with the top stock in the world, Apple Computer. You have made some positive comments in the past. Seems to be running at a little resistance here at 129. Are you letting some of your stake go at 129?
No, not at all, Joel. And as you're probably aware, since our last interview, there was a second letter published by activist investor Carl Icahn, and it's probably worth reading, I think, for any shareholders. It's difficult to find fault in Carl's reasoning. If you look at his math behind his projections, his revised price target of 216, it's not hard to get there. And importantly, I think, if we increasingly this idea of wearable technology, this really personal new device they have, the watch. I'm increasingly, bullish on that product. Nobody knows for sure if it's going to take off, but could they do 50 and 20 million units in the first year? Certainly. And I think that iPhone franchise, it's an incredible business. I mean, even if the iWatch or the Apple Watch, doesn't take off, you're talking about an install base of 415 million iPhones. Something like only 15% have been upgraded to iPhone 6. They've got a huge momentum with people converting from Android. And you've just got to figure that those other 380 or 390 million other iPhone users, they're going to upgrade sooner or later. And that phone has a very high ASP, very high gross margin. There's still a tremendous margin of safety in that stock
My
for the foreseeable future, the next couple of years probably.
only question on that, Reverend, is
Sure.
I wear a watch. Do you wear a watch?
Actually, I don't.
Okay, and a lot of the younger generation, I'm looking around at the people in the office. Brianna wears a watch, but I don't know. I mean, these younger generations, and I know everyone's buying iPhones and stuff, but do you think the iWatch is going to? I mean, they really need all ages. You think gonna change things around? Do you think the younger people are gonna be buying the iWatch?
It's really hard to say because nobody really knows. I mean, young people are their preferences change quickly, and they're the trendsetters. You're right. I don't know for sure, Joel. I don't think anyone knows. But, Tim Cook the other day in an interview, forgive me, it may not have been an interview, it may have been in the Goldman Sachs conference. He made a comment that he couldn't live without it. And I don't think he's lying. If you read about what this personalized technology, wearable technology is really all about, it's really about satisfying some of the notification needs and information needs that are light and that you don't necessarily need to pull a phone out of your pocket for. And of course, if you look at young people, how they interact through Snapchat or instant messaging, Facebook and so forth, there's a whole lot of notification going on and texting and so forth that if you could just get it on your wrist, I could see that fulfilling a unique need. I'm not sure, and nobody's sure. Obviously, the unit volumes are very low for most of the Google Android watch devices. I think they sold in aggregate 750,000 units last year. Not a big number, but if anyone can introduce that, I mean, if that is the future wearable technology and it does satisfy a new need, why would Apple not be the one to succeed?
Okay,
Would be my thought.
let's move on to your next issue here, and what an incredible move in WWE. I mean, holy mackerel! I bet you even you were surprised from this move from 10 and change up over 17.
Yeah.
It has to be tempting to try and sell some stock into that rally, or is it still below your target price?
WWE it's a special situation, Joel, for sure. And in full disclosure, we actually did sell at 1650, right around there. We bought around 10 or 11, and we bought more when it pulled back. There was a commentator on CNBC, another fund manager, who said his best short idea was to short WWE at 13. Seemed really strange to us. We didn't sell because we think the WWE franchise doesn't have tremendous value. Its IP it does have tremendous value. Even its OTT network has great value. But we continue to stand by our position since the original short thesis back in March 2014 that what's needed really is change in leadership. or sell the company. I think trying to make an analog out of WWE alongside the likes of Netflix is really a desire to express a longing for the sort of valuation multiples that Netflix gets. But what you have is a legacy company with a legacy culture and legacy DNA, and cultures and the DNA of a company set very early on in its formation. You can't take an industry like professional wrestling and live events and simply transpose on top of it as if it were a technology company in Silicon Valley that's going to lead the way in content distribution or a new paradigm.
Are you completely
They probably would have
out?
been better off partnering with the OTT network, with their legacy syndication partners.
Are you out? Are you completely out?
We kept one share.
You kept one share.
I think we made maybe 40 or 50% on the upside. I think we made more than that on the downside. It worked out very well. Vince McMahon controls the voting shares, so you're partnering with someone who's really not a partner, actually. And it's not clear that he's really interested in selling the company, and it's not clear that he's really sufficiently built a bench he's 69 now. I hope he lives to be 110. But it gets increasingly difficult to will is sort of power of a company. It's totally autonomous rule, and where's the bench? I mean, who's going to succeed Vince McMahon? And I think that 3 years ago, if you read their annual reports, they were talking about OTT network sub pricing of $15.99. Last November and February, we're down to zero on that. It helped the sub numbers. It's probably going to help through WrestleMania. The shares, for all I know, could continue to rise through WrestleMania. Who knows? But nobody gives things away for free if they don't have to. Apple doesn't give away iPhones for free because they need to do that. And that's a slippery slope. Once you go to zero, it's really hard to go back up.
Okay, let's move on to the next issue here. On January 29th, you warned. This hedge fund manager says stay away from Alibaba well ahead of earnings here. And this stock is trying to form a bottom here. Do you have a place where you would be interested in Alibaba?
No. It's a new issue. It's a young company. There's enough stocks out there that you don't need to go value picking amongst the IPO world. And importantly, Joel, the key thing with IPOs is that, this is a transfer from existing shareholders when the company was private to new shareholders when it goes public. And there's a great deal of effort made from insiders in the company and their marketers. I mean, the investment banks which underwrite the IPOs to promote the stock, usually at a price which exceeds its real value. And there's a lot of exiting going on. So we can't overlook that or forget that. If you're looking to buy an IPO, what's the underlying motivations of the sellers of the stock? And that's almost universally true with IPOs. Okay. Not that every IPO is bad, but there's just too much risk because the seller's interests, in this case, again, the underwriting banks and the insiders who are making the shares available, their interests are not aligned with yours as a retail investor. So important to remember. And you, most of the time, you've got companies that you certainly couldn't justify the price based on their financial showings. And in the case of Alibaba, as well as so many other companies, you don't usually have a very long public track record upon which you can make a qualitative assessment.
All right, another one, and I will never forget your comment. You're the only person that's ever come on our show that said, if you need to mortgage your grandmother's house to buy shares of this stock, then you should do it. And that was KLIC, KULR Sophia, and those shares are making a nice march here, hanging out near the $16 level. Buy, sell, or hold on KLIC.
Yeah, click again. Another interesting situation. I think they went up to 1650 or maybe 1670 recently. So we had close to a 50% return for our investors on that issue. Clearly a safe stock. They've got a growing war chest. It's going to continue to grow. Really sound underlying legacy business, which is a cash cow. The key issue with KULR and Sophia, which presents risk, is that probably the culture at the board of directors level is incorrect. Executive compensation continues to be a problem. They did initiate a 100 million share repurchase after we wrote a letter encouraging them to do so. We applauded that, and we commended them for heeding our call for that. But they've been very, very slow to actually exercise that. They bought a company in Europe called excuse me, it's given my the name wrong. They paid $100 million, $98 million, and it's going to be accretive in 2015. Assembleon, excuse me, the name of the company is Assembleon, but it wasn't a screaming bargain for them, and they'll continue to grow the top line revenues, but they've really got to take another look at how they compensate management, because it's really become a stock issuance machine, and the problem with that is that their underlying business, which is generating all this cash, which is allowing management to award themselves all these options, it's a business which is pre-existent, and it's not really a result of this management team's leadership yet. This management team may very well continue to grow the business and on its own merits, but it would be far better if it simply got a monetary reward or a bonus at the end of the year and bought shares in the open market like everyone else, every other owner. But I suspect in the not-too-distant future we may see changes in the board, and that would certainly be a good thing for KULR and SOFA. In terms of the industry, interconnects are going to continue to grow at an exponential rate. So as the Internet of Things emerges, you're going to see a need for wire bonding to increase. And they are staying on top of the technology trends. I mean, I continue to believe they're going to be a leader in advanced packaging technology. So, if you're a shareholder, you'd probably be safe holding it. But it's not a pristine issue by any means. I mean, you're partnering with a management team whose interests are not exactly aligned with your own. So you got to go into it knowing that ideally management changes their culture and their approach to shareholders.
Okay. Again, Pharmaceuticals, I know you're out of this one, but wow, big rally in it over the last few days. Are you still kicking around with one share of that, or did you wash your hands?
Go for it. You got to scratch your head on that. No, I think we stayed short like $5,000 or something like that just to keep an eye on it. And, we covered the short in the low 40s, I think 43 or 44. So the timing wound up being good on that. But, you just got to marvel. I mean, all of their key product pipelines are either stagnant or declining. Some of them are increasing, but very marginally. They're just a strange company. I mean, they've got this huge debt. They're not really using it for the buybacks. A very, very expensive debt offering, their bond offering. I continue to believe the company has really no intrinsic value. And I think that over the arc of time, you'll see this company probably cannot maintain these market valuations. So, I wouldn't give stock advice or anything, but sometimes I look at it, I can't help but think, boy, it looks like another good short idea.
Okay. Any other things on the Reverend's radar here? First, let's start.
We talked about Geospace a few interviews back.
Yeah.
We bought 2% of that company, and the shares have basically tanked since that time. Probably worth mentioning, we started out with about a 2% share in that company, and oil and gas, it's really remarkable. I mean, the longest decline in prices in that commodity, I think, in history, 7 consecutive months. And gasoline prices, same thing. I think the longest consecutive decline in gas prices on record. But, we continue to build our stake in that company. Last time I checked, I think we had 450,000 shares, so about 4% of the company. It's been a lot like being a kid in a candy store, Joel. I can't believe it. When that stock hit $18 or $19 a share, they've got almost $25 in book value, almost all of it's tangible. This is a company that only 4 quarters ago had record earnings, about $24 million. They reported February 5th, 2014, and record earnings for 2013. Not even 3 quarters later, they're reporting their worst quarterly performance on record. And in 20 years, I think they had 2 or 3 years where they had a loss. People look at the price of oil and gas, they get awfully afraid, but if you look at the price of oil and gas at the trough of the financial crisis in 2008, for example, Brent crude was trading at about $43 a share. Recently, it was trading about $45 in January. But you really need to adjust for inflation. I mean, M1 and M2 money supplies up about 45% in that time.
Yeah.
So, if you were to adjust in 2008 dollars, you'd be talking about $28 a barrel crude. And, the global infrastructure for liquefied fossil fuels, it's immense. It's going to change to renewables eventually, but that's going to be many decades out. Some of the product lines Geospace is working on, namely their OBX systems, their underwater monitoring system, that nodal system is clearly the leader in the industry. And oddly enough, this is not well known in the industry, but that's one area of the oil and gas E&P sector that has not really been affected. And, this company, we've been very consistent all along. We really believe they're just, 1 or 2 big contracts away, probably a PRM system away from tremendous turnaround in its value. So at $18 or $19 a share, I mean, you're getting really just net current asset values. I mean, at that price, you're talking about a company with a market cap of $235 million. You take total liabilities out. You're down to 210 million, about 21 million total liabilities. That leaves you with long-term assets, namely real estate, machinery, and so forth, all depreciated value about 110 million. So you're buying those things at like 24, 25 cents on the dollar at $19 a share. And we keep buying. I mean, like I said, just kid in a candy store experience. Great management team, honest, shareholder friendly. They don't pay themselves too much. Very capable. And, I've been down there and, you're getting hundreds of thousands of square feet of state-of-the-art equipment and manufacturing. Again, 25 cents on the dollar. And you're getting a great management team, intellectual property, customer relationships totally for free. So basically the company is going concern. It's basically free at that price. It's really an asset sell as if it were in bankruptcy, but a company with 100 million in liquidity, no debt, 146 million in sellable inventory. That's every value investor's dream, I think.
Okay.
I probably shouldn't talk about it so much before we buy more shares, for that matter.
I think there's plenty of people willing to sell it to you here. The stock has come down from
over. Oh, good. I hope so.
Over $100. So I appreciate you being candid there, because we talk about a lot of your good calls and everything. I really appreciate you, being candid there and talking about something that's moving against you. Any final thoughts on the market?
We feel like it's moving in our favor, actually, Joel. I mean, I couldn't believe it when it went from 28 to 18. I mean, it was like I said. I mean, we just can't buy fast enough. So.
Okay, all right. General markets thoughts here. It's showing a little weakness today. Market's been hanging out near all-time highs. Just any little pause here, a little pullback. Any thoughts on the market?
Well, generally, if you look at earnings reports of most companies, it's not all good times. There's very few companies out there that are doing well, and it's very different than it was a year or two ago. Stimuluses in the market have not only been cheap money as a result of all this quantitative easing over all the years, but it's also been companies buying back. So you've got corporate America is participating in buying the indexes, essentially, their own shares en masse. That started about 3 years ago, and it's really ratcheted up. But if you look at what's going on in the rest of the world, in the BRIC countries and so forth, I mean, they're in real trouble. And from our perspective, I mean, over the last really 10 years, I never understood personally the investments in China and Brazil and Russia and so forth, because you look at these countries, I mean, you wouldn't want to live there, right? I mean, you wouldn't go to Russia and say, hey, great, they uphold the rule of law here, and corporate ethics and governance is really outshines. Same thing in Brazil. I mean, you probably have security issues just getting off the plane, so why would you buy a piece of a company in one of these countries? And now those problems are really emerging. I mean, I think they're coming home to roost, these problems. And same thing in India. I mean, these countries, they were sold heavily as emerging markets, and people invested in them wildly. And now these problems are emerging. I think America looks that much safer. It's not that all is rosy in America. And, the markets are expensive, so be cautious. But, you probably would still do very, very well to try to find just a few good concerns in the U.S., in a market that largely is still the best in the world. Europe's not without its problems either. And, having just lived in Europe recently and on and off during my life, I can tell you that God bless them in Europe, a wonderful continent, wonderful people, but they don't have the work ethic that we have in America, and they don't have the drive and the vision. There's a reason why there's no equivalent to Apple or Google or something like that emerged in Russia or India or Switzerland, for that matter. We're still the greatest country in the world, and I still continue to believe that American enterprises, as dynamic organizations, will outperform all other asset classes over any measurable period of time. So there'll be pullbacks and things will go on sale and things like that. But if you're looking out 10, 20, 50 years, you're going to do very, very well to find a few good companies in the U.S. and buy them and hold them, and really that's probably the way to really create wealth.
Okay, we've been on the line with Reverend Emmanuel Lemelson of Lemelson Capital Management, the top hedge fund performer. Thanks a lot for coming on. We appreciate your insights into the market, and I'm sure we'll be speaking to you again soon.
Thanks so much, Joel and Brianna. I'm really humbled and grateful for the invitation and the opportunity to be with you this morning.
Okay, all right. Thank you, and have a good day. S&P's little bit of trouble out of the gate here. Couldn't recover from those sale imbalances. Went down to 84 and a quarter, trying to recover here, but we're running late, Brianna. We have such a good interview here. I didn't know, lost track of time. You want to preview the show for next week?
You bet I do. Well, we are going to have Anne-Marie Band returning next week. She's a financial analyst and author of The Trading Book. We're also going to be starting a weekly segment with Scott Redler. He's the chief strategist at T3 Live. Also returning to the show next week, Russell Rhodes from over at the SIBO, Todd Schoenberger. We'll have Nicola Duke of Futures Tech. She's a future trader. And then Fari's colleague Ashraf Lighty. He's the Hamzy Analytics HFT Forex strategist. Greg Harmon returning, Sheldon McIntyre, Nate Tobick, and one of our favorites, Paul LaModica, digital correspondent at CNN Monday. The week after, we have a great surprise for you guys. We will be joined by Gene Munster on Friday, March 6th at 8:35 a.m. So please don't miss that, guys. It's going to be a fantastic segment. Just a final reminder, our show is brought to you by our friends at Nadex, where you can find protection from market spikes and opportunities in flat markets using binary options. Open an account today with no fees and only $100 for your minimum deposit. Tell them your friends at Benzinga sent you. If you miss any part of today's show, you can listen to the whole thing again on our podcast. Find us on iTunes, SoundCloud, and Stitcher by searching hashtag premarket. Don't forget to tune into our next special segment next Friday, February 27th, all about crude oil, where you can discover the most profitable investments in the energy sector right now for free with experts like Doug Cass, Dennis Gartman, and more. And finally, please always remember that all of the information, material, and content in our program is for informational purposes only. Investing in stocks, options, and futures is risky and not suitable for all investors. Please consult your own independent financial advisor before making any investment decisions. That's all I've got for you, Joel. I'm going to kick it back to close the show.
Okay, all right. S&P's under pressure here, trading down on $10 here at 85.75. We'll see if the down move can continue. I want to give a shout out to our new listener in the chat, Alex. I hope you pop in with some symbols next week. Have a great weekend, great trading day. We'll be back with you on Monday.